We're at 9 o'clock now, so I think we'll begin our webinar for today. I want to thank you all for joining us for the webinar today. My name is Joan Popolo, and I'm the Executive Director of Action Innovation Network. And for those of you who are not familiar with our organization, we are a collaborative network of technology business incubators located throughout the New England region. We're a membership organization, a nonprofit. And the incubators in our network are supporting companies in the industry sectors of life sciences, clean tech, robotics, advanced materials, and ocean and maritime. So we reach a broad range. Our network, we provide a suite of resources for our network for sharing. We provide benefits for our network incubators, and that's how we work together in a collaborative nature. Just a few housekeeping items before we start the webinar. All of the attendees will be muted, both audio and video. The presentation should be about 40 minutes, and we will leave remaining time for questions and answers. If you have any questions that you'd like to submit, there is a chat box that you'll find, and please type your question in there, and we'll get to them at the end of the webinar. And I'd like you to know that this webinar is being recorded, and it will be posted on our website for future viewing, and also sent to you in an email with the slide deck. So we thank Leyton for providing all of that. Today's webinar is titled the R&D Tax Credit for Small Businesses, and is presented today by Taylor Cortes, the Senior Research and Development Credit Consultant, and David Roberson, who's a senior tax attorney, both of them at Leyton. Taylor has been working with small businesses and startups across the U.S. to claim the R&D tax credit for about 2 years. She works across a variety of industries, from life sciences, software, engineering, and government. And David, as the senior tax attorney, he specializes in tax law and has vast experience with not only conducting R&D tax credit studies, but also defending them during audit. So with that, I'd like to hand it over to Taylor, who will begin the webinar presentation.
Good morning, everybody. Thank you for joining David and me this morning, bright and early. And Joan, thank you for the introduction. So today we're going to be talking about the R&D tax credit and how it can benefit small businesses and startups. The way the legislation has evolved recently, it has become a great tax savings for small businesses, but it's definitely been something that has flown under the radar, even though it's been around for decades. So the whole goal of this webinar today is to introduce everyone to the R&D tax credit, how it's evolved recently, because there's been some pretty major changes that now make it a great credit for small businesses and younger businesses. So just to give you guys a little bit of background, Joan introduced us, the presenters today, but Leyton is an R&D tax credit specialist. So we have offices across 11 countries, and every country we focus on just the R&D tax credit. What makes us a specialist, other than the fact that it's our big business focus, is the fact that we have tax expertise and technical expertise. So depending on what industry you're in, we bring in the relevant industry-specific consultants, which should hopefully make the R&D study process a lot easier, capture more of the credit that you guys are eligible for, but also make it fully defensible, which is why David's here. So without any further ado, let's jump into the agenda and what we will be covering today. So the first thing we're going to talk about is what is the R&D tax credit and how it actually provides some additional cash flow for your business. The second thing we will cover is what companies can claim. And in this section, we'll specifically highlight how broad the legislation is and how many industries are actually eligible to claim. Then we'll look at how do you figure out what is R&D, and you do that through a 4-part test. And you also can look at what qualifying expenses there are, so what can you actually claim for. And then the final major section that we'll be talking about is how do you actually claim the R&D tax credit? How do you implement best practices into your business to make sure that you're going to do it successfully and correctly. So then we'll also have time for questions at the end. So let's jump into how can the R&D tax credit provide additional cash flow? There are two versions of the R&D tax credit. The version that most people are probably familiar with has been around since the early 80s. It was designed to benefit typically larger businesses, those that needed to be profitable, which kind of ruled out startups and smaller businesses that maybe weren't. So with recent legislation changes, the R&D tax credit suddenly became a lot more friendly to smaller, newer businesses. And the way that happened was through the Payroll Tax Credit. So this is a federal incentive that's specifically designed for startups and younger businesses. One of the first expenses that startups or younger businesses are going to incur is probably a payroll. You're going to be hiring people, and that's going to mean you have a payroll tax liability that you'll pay. So this credit allows you to look at all of the R&D activities you've done throughout a year, relate costs back to those activities, and you'll ultimately get a dollar for dollar tax credit that you can use to reduce the Social Security portion of your payroll tax. This credit is a little bit stricter than the traditional version of the R&D tax credit because you have to be considered a qualified small business to be eligible. So when you look at, are you a qualified small business, you have to take into account, when was my first gross receipt? Because that's going to automatically enter you into a 5-year window to claim. And then you also need to have less than $5 million in gross receipts each year. So once you've entered into this 5-year window, you have to claim it on a timely filed return. So I'm guessing most companies that are listening to this presentation have just wrapped up their 2019 financials. Some will be getting ready to file around the March, April 15th deadlines. Those companies that are going to be filing around those deadlines, you'll have to get a payroll claim in your tax return before you submit it. If you're filing later in the year, September, October timeline, then you'll have a little more time to get a payroll claim back into your tax return. What's really exciting is this credit didn't exist until the end of 2015. So when you look at how innovative are startups, how innovative are small businesses, it's probably one of the most innovative sectors. And there wasn't any way for you to benefit because you're probably not going to be profitable for the first couple of years of operation. So this credit has been a huge, huge game changer. And it's something that a lot of businesses are still learning exists. So the point of introducing it today is to ensure that you're aware of it. If you're eligible, you can absolutely claim it. And with the tax deadlines approaching quickly, it's a good time to start paying attention to it. The second version of the R&D tax credit is the one that most people will probably think of. It's the traditional R&D tax credit. This one allows you to reduce income tax liability. In a similar manner, it's a dollar for dollar tax credit. It does work a little bit differently because you actually can look backwards at what your R&D investment was. So right now, you could probably look at your R&D investment between years 2016 through 2019. So you've actually got 4 years instead of just one with the payroll tax credit. This credit can be carried up to 20 years if you aren't paying taxes yet or your tax liability just isn't incredibly significant. There's also a state version. So the state credits generally follow the federal guidelines. Most states, but not all of them, have a version of the tax credit. And now that the credit is permanent, this is something that you can build into your financial plans year after year and rely on as an additional source of cash flow. The idea being, if you are a younger startup and you're eligible to take advantage of the payroll credit, you'll start with that. And as you transition, you grow and you hit profitability, you'll then move into claiming the traditional R&D tax credit and potentially a state credit as well. David, is there anything you want to add on the introduction to the credit?
Well, no, I think you did a great job covering that. Thank you for your explanations. One of the things that I would bring up, as far as Taylor mentioned the legislation a couple of times, and the original legislation was 1981, and we were still seeing updates even as to 2015. So anything that, I like to say anything that Reagan and Obama and Trump can all agree on, probably pretty good deal. And they're actually introducing legislation right now to expand the payroll tax credit. So point being is that it's a well supported. It's not something just straight off the presses. It's something that's been around for a while. Something that has been an established part of the tax credit incentive programs that the government runs. And we would behoove you to take advantage of it.
So, what companies can claim? You're not really supposed to read this slide. The point of this slide is to introduce how broad the legislation is, how many industries can qualify. People often have, I guess, a little bit of a bias towards what is R&D. People traditionally think of the life science space, and they think you need to have a dedicated lab and people in white lab coats working with test tubes and maybe doing drug discovery. But in reality, the R&D tax credit legislation was written incredibly broadly, so any industry can qualify. So if you don't see your industry on here, it doesn't necessarily mean that you're not doing R&D. The point of this slide, as I mentioned before, is to show how many industries, how many companies can qualify. And as you grow your business, again, you'll still be able to move from claiming the payroll credit into claiming the traditional R&D tax credit. So it's absolutely worth looking into. If you're a little bit uncertain as to whether you do R&D, it's always worth a conversation with a specialist to figure out, are you actually eligible? Because it could be you are, and there's a lot of money sitting on the table through this tax incentive. So now that you know the legislation is really broad and a lot of industries can claim, you need to figure out how you actually figure out what your R&D is. So the way that it was set out in the legislation is through the 4-part test. So when you look at what makes this tax credit maybe a little bit tricky than other ones, is you need to go through your projects throughout any given year. So say 2019, for example. And each project you need to compare to this 4-part test. If it checks all the boxes, then you'll be able to say, okay, great. That aspect of what I did throughout the year qualifies as R&D. So let's jump into this. The first test is a new or improved product, process, technique, formula, software, etc. Basically that you need to be doing something that you're trying to develop something new or improve upon something that already exists. That is a core component of your business. That by investing in this, it helps keep your doors open, helps you customers. And the nice part about this legislation is you don't need to be doing something so cutting edge the US or the world has never seen it before. As long as it's new or something you're improving within your own business, something you haven't done before, then the likelihood is that you're going to be checking the first box here.
I like to call it, it doesn't have to be a revolutionary change, it has to be an evolutionary change.
Exactly. So good way to think about it. You don't need to be filing a patent with every change. It's obviously nice if you are filing a patent, but that doesn't necessarily mean you're doing R&D. If you aren't doing R&D, you don't have a patent. The second test is that it needs to be technological in nature. So you need to apply basically a STEM field to the work that you're doing. So when you look at, if I'm developing software or doing drug discovery, you're going to need people with special backgrounds, with engineering degrees, that understand the details of that specific field. When you look at something like marketing, there's not really a hard science field being applied to that unless you're coding and you're building a marketing platform, for example. So it's looking at something technical in a STEM field. Third is you go through a process of experimentation. So during this process of experimentation, you know what you ultimately want to achieve with this new or improved product or process. But you have to figure out what is the best way of achieving that goal I'm setting out. So throughout this process of experimentation, you need to be looking at different alternatives, understanding if I follow steps 1 through 10, I know I'm going to get that outcome I'm looking for, it's probably not a process of experimentation, really. If you're looking at, okay, I can approach this 3 different ways, what's going to be the best outcome? I'm going to try each different method. That's when you start diving into the process of experimentation. And then the 4th and final part of this 4-part test is the elimination of uncertainty. So this one is linked pretty closely to the process of experimentation, the 3rd test. And why I believe that is when you start out and you know you have a goal you want to achieve, but you're not exactly sure what the best way is of approaching it, there's uncertainty behind this development. Ultimately, what you're trying to achieve might not even be feasible. So as you move through this process of experimentation, you're going to understand, is this the best step forward, or is there a better alternative? Is this even feasible? Can we achieve the outcomes we want to achieve? So as you move through the process of experimentation, you're going to understand and eliminate uncertainty behind this process. David, is there anything you want to add to the 4-part test regulations?
No, I think that covers it in a nutshell. I mean, obviously there's nuances. I mean, that we can talk about, maybe in the Q&A session about fact-specific sort of things, but that's the broad strokes of it, and it hasn't changed in 40 years. So yeah.
Perfect. So once you figured out what your R&D is, what projects pass this 4-part test, you need to start looking at what credit, or how are you actually going to get a number. So there are certain cost categories that you can look at. So what you do is you'll go through a project analysis. You'll understand which projects pass that 4-part test. And then you can start looking at these costs to actually start building up what's considered your qualified research expenditure. And that is your big number of R&D investment throughout the year. So the first cost that you can look at is salaries. These are salaries of W-2 employees. The great thing about the legislation is you'll obviously be able to look at the people that are directly doing the R&D. So the software developers, the aerospace engineers, the people with biomedical engineering degrees. They will be hands-on involved doing the R&D. These people will probably have a high percentage of their time dedicated to R&D, which means you'll be able to allocate a higher percentage of time throughout the year to R&D. So if you say someone spent 75% of their time doing R&D throughout the year, they'll be able to allocate 75% of their salary towards their qualified research expenditure. But you don't just get to look at people doing the R&D directly. You can look at the people supporting it and the people supervising it. So supporting R&D could be a project manager, it could be a product manager. Supervising the R&D could be a direct line manager, it could also be an executive at the company. The people directly supporting or supervising the R&D will often have a little bit of a lower percentage of their time spent doing R&D, but they'll absolutely still be involved in the process. A great part about the legislation when you look at employee salaries is there's a part of the doctrine that is called substantially all legislation. So if you have an employee spending 80% or more of his or her time doing R&D, you get to capture their whole salary. So that bumps up to 100% of what they're paid throughout the year, suddenly goes to your qualified research expenditure. On a similar note, a little bit different than traditional W-2 employees, you can also look at contracted research. So if you're working with 1099s, for example, they'll still potentially be helping with your process. The goal of the credit is to stimulate the economy to hire more people, to grow local businesses. So the ideal scenario would be that you hire more W-2 employees, but obviously not everyone is going to do that. It's not going to make sense for their business. So at some point, you will probably work with some contracted research organizations or individuals. That's still growing the economy. It's still stimulating U.S. businesses. So you'll be able to claim for those expenses. There's just a little bit of a discount where instead of the full 100% that you have access to, the cost can be claimed up to 65%. You can also look at working with other basic research organizations, institutions of higher ed, so universities, federal laboratories. If you're working with businesses in certain sectors contractor, you also might be able to claim for a larger percentage than that 65%, even though the research is contracted out. Fourth area you can look at is raw materials and supplies. So it's what raw materials are you investing throughout the R&D process, throughout experimentation. You'll be able to capture those tied back to the R&D. And then you'll also be able to look at computers. So this is maybe one of the pieces that has evolved over time. You're not going to be writing on a supercomputer much anymore, but you'll be working with programs like Amazon Web Services or Azure. And if you're developing some technology in the cloud, you'll likely be able to claim for some. And then the final cost category that you can look at is legal fees. So if you are filing patents, there's probably going to be a good amount of legal fees involved to actually get that patent successfully filed. You'll be able to look at some of those costs as well. So ultimately, what you'll do is you've identified your R&D projects. You've now tied certain expenses back to each R&D project, and you'll have your big number that you've invested in R&D throughout the year, and that's your qualified research expenditure. From there, you'll get a percentage of that total investment back, depending on the age of the company, the amount of R&D that you're investing in year after year. You'll probably sit somewhere between a 7 to 10% R&D tax credit. As a reminder, this is a dollar for dollar reduction. So the way that that impacts you is if you have a $10,000 R&D tax credit and you owe $12,000 in either payroll or income tax, it's easy math. You do your $12,000 in taxes and you subtract the credit from it. So instead of owing a full $12,000, suddenly you'll only have to pay $2,000 because of your $10,000 tax credit. So the dollar for dollar reduction is a little bit different than what your traditional deductions or expenses are that you might be doing. So you can do these in combination with each other. David, is there anything you want to add on the qualifying costs or actually calculating the credit?
Sure. One of the things I've pointed out about the raw materials and supplies piece is in 2016 they actually bumped this to where you can actually claim test beds and pilot models, the actual supplies that go into creating those physical pieces. So if you're manufacturing something and you have a prototype and you run through several different variations of it, and of course you finally get it to a point where you're satisfied with it. All those costs will go into the bucket, as Taylor mentioned. So that's an expansion that's taken place there. But other than that, I mean, that basically each of these cost categories is a chance to find money, right? A chance to find forward, and when you identify what those costs are, what activities those costs are associated with, you can then qualify the activities and qualify the costs as we've been discussing here with the 4-part test and the cost categories. So ultimately, the more money you can find, the more money you can essentially recycle and reinvest.
I think that's a huge piece that we haven't really talked about yet. This is money that you are investing in your business anyway. You're investing it in your employees, you're investing it in contracted research that you might be affiliated with, you're investing in your product or your process, whatever your offering is. And this credit allows you to recapture part of that investment. So you're going to make it anyways. You might as well look at and understand, am I eligible for this credit? Is it a substantial value? Will this impact my business? Is it worth spending the time to actually claim it? Does it make sense to claim it now? Does it make sense to wait a year? And there's a lot of things that you'll have to take into consideration. But this is money you're going to be investing anyway. And the government is letting you recapture a percentage of that to lower your tax liability. And the goal is you'll continue investing in more R&D, you'll hire more employees, and you'll continue stimulating and growing and keeping the U.S. competitive. So now we'll move into our final section of what we wanted to discuss today, and it's how do you actually go about claiming the R&D tax credit, and what are some best practices to ensure that this is something that you're doing correctly, that you're maximizing, and that you're doing year after year. So the first piece that I want to address is this tax credit became permanent at the very end of 2015. So it is something that you can now rely on and build into your financial plans year after year, the money you're already investing. This is a little bit different than when the credit was being renewed or modified slightly every year, every other year back in the 80s, 90s, early 2000s. So the credit is continuing to improve. As David mentioned, there's legislation out there to make the payroll credit an even better opportunity. But it's something that the government wants to see you claiming because they want you to make this investment in the US. It's absolutely something that you should look into, and what the government would ideally see is you can, as I mentioned before, start with claiming the payroll credit if your business is at a young enough stage to do so, transition into claiming the traditional R&D credit when it makes business sense. So this is definitely something that shouldn't be flying under the radar anymore, something that you continue putting off. You can build it into your financial plans, and it'll be hopefully a good source of cash flow year after year.
Another point on the financial planning, especially in situations where you have small businesses or startups, or people that are seeking maybe Series A funding, Series B, etc. One of the things that really is kind of a feather in your cap on this sort of thing is that, hey, if you're claiming the R&D credit and you can put that into your investor presentation or your ownership presentations, to drive the investments. Basically, if you think about it, if you're running a startup, or anything that's really your baby, if you will, you're going to have the greatest people that you can afford. You're going to have a great idea, and you're going to be wanting to show people the progress you're making. But you also want to tick that financial responsibility box for people that potentially investing money, because they're going to want to know, yeah, you have this great idea, but there's a lot of great ideas out there. What's going to be something that sets you apart? And having the knowledge and the wherewithal to leverage the R&D tax credit, is just one more check, if you will, in the analysis.
Absolutely, and this is a non-dilutive source of funding, so that makes it a little bit different because you're not giving away a piece of your business. And as David mentioned, you absolutely are demonstrating that you are being fiscally responsible with any investor's money. The easiest example to look at it as is if you get $100,000 from someone and you invest all of that in R&D by claiming the tax credit, you can essentially turn that into $110,000 because you'll get that extra $10,000 to reduce your payroll or income tax liability. Looking at you lengthen that runway is something that not a lot of smaller businesses or startups are going to be aware of or doing because they don't want to dive into the nitty-gritty tax yet. So showing that you are aware of this tax incentive, that you can lengthen the runway that you're being provided by investors, it's going to make them a lot happier, and they'll see that you're hopefully worth that investment. So the second best practice is understanding the IRS legislation, because this is the world of taxes. There is a slim chance the legislation, now that it's permanent, companies are actually starting to pay attention and claim it correctly. But there is always a chance that the IRS or your state government comes in and says, hey, we're going to do an audit of your tax return, including an R&D tax credit. How did you calculate this? And they'll want to make sure that you didn't just say, I think I spent $1 million in R&D, so I think that's a $100,000 tax credit. I'm just going to put that on my return. That it probably isn't the safest way to go about this process. So making sure that you understand the legislation, understand why you can qualify certain projects, why you can qualify certain costs. That is a huge piece. And maybe some of you guys have heard nightmares about this credit. It definitely was one that people took advantage of, I think, in the early 2000s.
Well, I mean, it was when it first came out in the 80s, there was really no understanding, and it was a very, very immature program, but obviously 1981 to 2020, we're talking almost 40 years. There's been significant legislation changes, IRS guidance, commissioner's advice, revenue proceedings, revenue rulings, all these fun things that I get to read, so you don't have to. But also, America is a litigious society, but we've taken these issues, and the IRS says no. Well, a lot of people take issue with it, take it to tax court, and as a result, the rulings come down, and there's variations that have really matured the credit to a point where the playing field is there, and the lines have been drawn to some extent. But it's really important to know where they are. What's significant about this, how to go about this, because they really have done a lot of work, and a lot of millions of dollars between taxpayers and the IRS has been poured into really refining this credit down to what beyond the 4-part test. Like I said, there's many nuances that go into what is a process, what is all these sorts of things, and all these questions that have been answered, and as a specialist, Leyton is well versed in those. We keep up to speed on those, and me and my team, we're specifically focused on the IRS legislation and how that changes things, and maybe moves the boundaries or gives clarification in certain areas. So there's a lot out there. It's a matter of being able to digest it, and then, as Taylor mentioned, apply it appropriately and accurately to what you're doing.
So then, tying in to that, it's properly calculating the base years, making sure that you include all eligible expenses, but no more than that, in regulation with the IRS. Is there anything else you want to add on that?
Yeah, so the base period term is probably something that maybe has given some question marks in your head over the scope of watching this. And the base period is the IRS has a 3-year, what we call the base period. But what it does is it provides a starting line, if you will, for credit increasing research activities, right? So if you look at, so for example, let's say it's 2019 now, and you're filing for the 2019 R&D Tax Credit. Well, the IRS is going to have you look back at 18, 17, and 16 costs and run them into a calculation that provides sort of like I said, a starting line or a foundation for what's going to be the amount of increase. It's a little bit of a complicated calculation, especially because the cost categories have to be treated consistently across the board, across the 4-year period that you're looking at. And it's a matter of analyzing not only the costs that you're expending now, but the costs that you expended in prior years. So that one's always and of course there's several methods that you can use to calculate the base period. The ASC, alternative simplified credit, to name one, the startup methodology, the AIRC, all kinds of calculations that can change the value to you as the credit dollars.
I think it is definitely worth reiterating. He mentioned a startup method. If your business is newer, or you maybe don't have documentation to go back 3 years because that was when your business just started and things were a little bit crazy, there are ways to work around the base period calculation. So it's just understanding what information do you have, understanding when your company was founded, can you do the 3-year base period, can you not, and picking a method that will give you the best credit, but also you'll be able to support that most strongly. So on that note of being able to support your claim, the best way to know, and I'm going to move and we'll talk about both people, it's kind of simultaneously. The best way to support your claim to make sure that everything is R&D is by starting to track your information in. So once you understand what projects have R&D in them, what the legislation looks like, what potential costs can be included, you don't have to do anything crazy rigorous or upend your whole tracking system that you use. But being able to flag certain projects or aspects of projects, being able to flag certain costs, as you do that throughout, say, 2020, for example, you'll be able to pull back information and build an R&D claim when the year is over and have that documentation it'll be a little bit stronger, because you won't be trying to think, okay, it's January 2020. What did I do in January 2019? What qualifies as R&D? So being able to track this information in real time is going to strengthen your claim when you actually get to the point where you're going to file it. What you'll find is you can use any kind of ordinary business documentation to keep track of your projects throughout the year or your financials throughout the year. But what a lot of specialists will do is they'll actually prepare a report, and that is the fourth bullet. And that report takes all of your business documentation and puts it into something that the IRS would want to see. That says, here's how my project passed the 4-part test. Here's why we had to go through a process of experimentation. Here's why it was technological in nature. Here are the people I brought in. These were their backgrounds. It breaks it down in the way that the IRS would need to see it. It also then links all of your costs back to the R&D projects. So if there are ever any questions on your claim, a report like that kind of answers them all succinctly in the way the IRS would expect to see it, which also takes work off of your shoulders, because then you don't have to try to compile everything and understand how should I be answering these questions. So a report like that is definitely something that it's like insurance to some extent. You might not need it because you might never have to talk to the IRS about your R&D credit, but it's something that specialists will provide, and it is a nice to have, and kind of gives you peace of mind.
Yeah, a couple points on the information piece. As Taylor mentioned, you're not upending your whole tracking system, changing everything about. Obviously, incremental improvements is always something that's recommended. The other thing to point out about this is that the R&D tax credit is an activities-based credit. And what that means is it relies on the activities that you're doing, the work, the products that you're doing, then ties that the costs associated with it. But there has to be some means of supporting that claim. And the IRS, whether it's fortunately or unfortunately, has said we need what's called contemporaneous documentation. And that means documentation that's kind of tracks the development activities and tracks what's going on with them. But unfortunately, they haven't given any more clarity on that. So it's a matter of what types of documents do we need, and that's kind of the idea there is to compile things. I've used everything from Outlook calendars to PowerPoints to technical drawings to reports that are 300 pages long to compile a support for the R&D credit. Now, as Taylor mentioned, a substantiated report, outlining what documentation is available, outlining, describing the activities and the projects in a narrative form, and how does it fit the 4-part test. That's a very succinct and very easy way to present your claim in a matter of a few pages. Maybe several dozen pages if you're bigger. But then having that documentation sort of in your back pocket is not only recommended, it's required.
So now we can kind of transition into the Q&A. Before we jump into that, I want to say that this is tax code. We have absolutely simplified parts of this down. I'm guessing you guys have seen some of the points where it does get a little bit more complicated than just saying, I think I'm doing R&D, I'm going to get some money back. If you have any questions, please feel free to reach out. I know my contact info is on this slide, and David and I both have contact info on the first slide, which you guys will be emailed out. There's a lot of merit in finding a partner to walk you through this process if this isn't something you've done before, or if it's something that maybe your CPA isn't as familiar with or as comfortable with. It is tax law, so it definitely does get complicated and can seem a bit scary, but now that this is a permanent incentive, it's absolutely worth looking into and understanding how you can claim it, what credit you're potentially eligible for, because this can be a really lucrative way to get you guys to continue investing in the US, in your business, and in research and development.
Yeah, and on the CPA piece, a lot of CPAs themselves aren't aware of the nature of this credit, and nothing against any of them. They're consummate professionals. But as I like to say, the tax code is 9,000 pages long. We specialize in 500 pages, right? And if you have a CPA, we're not interested in replacing them. We're interested in helping them and adding value. So it's a chance to drill down on an area that is valuable, and that like I said, not a lot of companies and even CPAs aren't aware of it or how it works.
Great, Joan, do you want to?
Yeah, a number of questions here. One question, first of all, thank you for presenting that. You made it in a simple form that I could understand, but I know there's a lot of details as you go deeper into it. So some of those questions, we'll maybe delve into that. One that we received from a participant today is, and I'll read it: to clarify, the credit is only against Social Security deducted from payroll. So say my startup paid $3,500 to Social Security in 2019 via payroll taxes. My max tax credit is $3,500? That's the question.
Yeah, happy to answer that one. Thanks for the question. So a couple of points is the payroll tax credit has a ceiling of $250,000. So if your R&D spend that was qualified, whether it's salaries, wages, contract expenses, supplies, materials, etc., there's no limit on it. If you can qualify enough of it, you can get up to $250,000 in a sort of a rolling declining balance sort of credit to your account. So for example, so let's for argument's sake, $250,000 you generate $250,000 tax credit. You get to use that money to offset your employer contributions to FICA, which is about 6.2%. And you get to use that on a rolling basis, meaning that every 2 weeks or a month, whenever you're on your payroll, you're banking that contribution back against that 250K max payroll allowance. So to answer your question, to answer the question more directly, rather, you could generate a tax credit that's much bigger than $3,500. You'll only be able to benefit from $3,500 of it in a given year, but then as your payroll increases, that number's going to increase as well, and you'll have that in your back pocket. And of course, you get to use that 250K until it's used up. It doesn't expire. It doesn't go away. And let's say the next year you generate another $250,000. Well, you get to throw that in the bucket as well. It keeps compounding on itself.
And I think also on that note, what you'll do is you'll look at, okay, what was my R&D investment in 2019? What employees were involved in R&D, what raw materials, et cetera, and you'll be able to get a percentage of that total investment back. Once you file your 2019 tax return with a payroll claim in it, you'll start reducing that tax liability on a go-forward basis. So if you are a pass-through entity and you file without an extension, so your deadline is March 15th, you'll file for a payroll claim in Q1. You'll start reducing that payroll tax liability in Q2 of 2020. And you'll continue reducing that tax liability every quarter until you run out of credit. Then when the 2020 ends and you're still eligible for the payroll credit, you'll be able to top up, as David mentioned. So you'll get another $10, $20, $30, $250,000, and you'll be able to go through that process again, where you reduce your payroll tax liability every quarter until you run out of credit. So hopefully that answers the question a little bit more than the presentation did.
And I have a follow-up to that, just to be clear. So it's a maximum of $250,000 per year
for the five years that you there right now. Has proposed to make the payroll tax credit a lot better. And one of the ways that it would do that is by raising that $250,000 ceiling.
Is there a lifetime cap or anything at this point?
Joan, can you repeat that last question you're asking?
Yeah, I'm getting a little bit of stutter. Is there a lifetime cap? maximum?
So for the payroll tax credit, you can only claim it for 5 years, and that 5-year window is marked as soon as you have a gross receipt. The traditional R&D tax credit, so once you outgrow the payroll credit or you aren't eligible for it today, the traditional R&D tax credit has no cap. It's permanent, written into the legislation. You can claim any value that you are entitled to year after year. There is no cap.
What in a prior position with KPMG in this sector myself, Bank of America takes advantage of this credit, and their credit was $400 million. So there's really no limit.
And there's a second question from the same participant. Does the evaluation of alternatives and reduction of uncertainty have to take place in each year? What if that's a multi-year process?
So if it's a multi-year project, that's fine. No, nothing wrong with that. We'll look at the activity itself and qualify on a yearly. It is on a yearly analysis because it is a tax year. So, for example, if you're working on a 3-year project, and in year 1 you did X, Y, and Z, and you expended $1 million, well, that's going to be $1 million of QREs which is over $100,000 in tax credit. Similarly, if the project continues into the next year, well, then the costs that were incurred, for salaries or for prototyping or what have you, they'll be captured on a tax year basis, right? So every year you look at the activities, what's being done, does it qualify, and what costs were expended in that year that you can claim on your tax return. So that's kind of how it breaks down.
Okay, another question here. I'm not profitable. How can I possibly qualify?
So that's when we would look into, is your business eligible for the payroll tax credit? With the payroll tax credit, you don't need to be profitable. You can be, but you don't need to be. As I mentioned before, this is one of the ways that the IRS is trying to make the credit more accessible to smaller, younger businesses. So the payroll credit was created because one of the first tax liabilities that companies are going to have is they're going to be bringing on employees, which means they're going to be paying salaries and they're going to have a payroll tax liability. So the credit, what the ideal situation is that you're a qualified business, you're eligible to claim the payroll tax credit, and you'll be able to reduce a different tax liability than what the traditional R&D tax credit allowed you to reduce, which was your income tax. So the goal is, by introducing this other version of the credit, specifically designed for startups, you'll still see tax savings and you'll be able to reinvest in your business, or go on vacation if that's what you want to do with the tax savings. It's up to you. But the goal is you transition from being able to claim the payroll credit into when you are profitable, claiming and benefiting from the traditional R&D credit with the income tax deduction.
Okay, so you just touched on this a little bit, but the follow-up question is, do you have to have revenue to qualify? Is that what you mean by the 5-year window opens with that first gross receipt?
So do you want to?
Yeah, sure. So the clock starts ticking, as Taylor's mentioned, as soon as you have a gross receipt of any kind. As far as having revenue, that's not necessarily something that is determinative. As far as paying the payroll tax credit, you're going to still be expending dollars for your payroll, regardless of whether or not you're bringing in revenue. Maybe your funding is through an investor or through cash assets on hand, or various ways of doing things, if you will, various ways of providing funding. So you see, like for example, a lot of biotech and pharmaceutical companies have a long run up, where they're technically generating zero revenue, or they're generating minimal revenue as they sell, test the market for this product and so on and so forth. But that doesn't require, they're not required to have revenue. And in fact, a lot of times they don't, because it's a situation where you're getting off the ground, but you're still incurring operational costs of payroll taxes, among other things. And that's where the payroll tax credit would help.
And just to touch on what is a gross receipt, obviously revenue, that would be an example, money flowing into the business as a gross receipt. But you would also look at it, are you earning interest in a bank account? Something as simple as that could also be a gross receipt that would push you into that 5-year window. It is always worth noting, like if you reincorporated your business, that would reset your time window. So if you received a new FEIN, so there are ways that your business could be allowed around longer, could have had this longer, but whatever, how you were structured, restructured, that could reset your window.
Is this something your CPA should bring up to you, or should know about already? Or is it really up to the startup company to bring it to the CPA and say, please look into this for me if you can? Oh,
I think David kind of jumped on that question a little bit earlier. He mentioned there are like 9,000 pages of tax code. Your CPA is helping with your tax strategy, your tax planning, filing your tax returns. They're trying to look into other tax incentives for you. They've got 9,000 pages on their plate that they're trying to take a handle on. I think, so to answer it is not all CPAs are aware of this credit. Some are aware, but maybe they're not comfortable claiming for your specific industry. So it's always worth asking them about it. What makes this credit a little bit more challenging and why some CPAs aren't comfortable with it is that technical edge that you need to go through and say, okay, what project qualifies? How does this pass the 4-part test? These people have backgrounds in finance and accounting and tax. They're not necessarily going to understand your drug discovery process, your building a prototype to go on a drone or on an airplane, or how you're developing that software. So as you're speaking with your CPA, the part of the reason why they might not have brought it up is because they're not comfortable looking at your business and saying, okay, this project passes the 4-part test, because they just don't have that background. So aspects of your development might get lost in translation, so things could be overclaimed or underclaimed. So when you look at why do specialists like Leyton exist, it's because we have that technical expertise. We bring the people with the relevant industry-specific backgrounds to the process. So it kind of acts as like a 3-way partnership. Obviously your firm, because you're doing the R&D, your CPA, because they'll be helping you file your tax returns, and us come in and essentially auditing your business with this R&D tax credit in mind. So I hope that answered your question. Your CPA's got a lot on their plate. So it's a ton of things to keep track of, and they might just not be comfortable with this particular incentive. But it's always worth asking, because it could be a great fit for your business and huge tax savings.
Yeah, and to add on to that, we don't want to ever cast any shade on your CPA. You know, we would like to think that as a professional, he or she is doing a great job, and we're here to add value. We're here to help explain that, because as I mentioned, it is fairly complicated as far as, you know, it's complicated in the sense, the R&D Tax Credit is complicated in the sense that there is, as Taylor mentioned, technical activities that have to be analyzed versus just the cost sheets, the P&Ls, the gender ledgers, and so on and so forth. So, you know, your CPA might be very comfortable with your GLs, but maybe not so much with, you know, your software engineering programming or your engineering design. When, you know, that's where the combination of analysis comes in, and that's what makes the credit run. And if somebody's not comfortable with, you know, I mean, I'm a lawyer, right? I don't know how to program a software program or build an app or anything like that. I've worked with enough companies that I can you know not to be dangerous, but at the same time, CPA is going to be most comfortable in Excel spreadsheets and accounting methodologies than it is with analyzing technical details and combining them with finances.
Understood. There's another follow-up to the gross receipt type question. Just wanting to know, to confirm, a 10-year-old business with first gross receipts 10 years ago wouldn't qualify for the payroll tax credit because they missed their 5-year window? And please, a reminder of the name of the other tax credit that they could pursue instead.
Sure. So the payroll tax credit, that would likely be correct unless you've reincorporated your business within the last 5 years. The traditional R&D tax credit, you could probably just Google R&D tax credit and it would pop up. If your business is profitable, you'll be able to claim for 2016 through 2019. Assuming you've paid taxes in all of those years, when you claim for 2016, 17, or 18, and you add an R&D claim into your tax return, you will essentially have overpaid your historical taxes, which means you'll get a check back in the mail from the federal, maybe state, if your state offers a credit, federal government. So that'll be checks that you'll expect to receive a couple weeks after you file. And then any credit that remains, you'll be able to carry forward up to 20 years. The credit's formal name, so we've simplified it by calling it the R&D tax credit. The formal name is the Credit for Increasing Research Activities, and you'll find the traditional version of that with the income tax relief from a pretty easy Google search.
Thank you. What if a business is planning to be acquired within the next couple of years? Is it still valuable for them to do this?
So if you are either profitable or you are eligible for the payroll credit, you'll have money that you can reinvest elsewhere in the business. If you aren't profitable yet and you are also not eligible for the payroll credit, you can claim the R&D tax credit and carry it as an asset. David, do you want to touch on that a little bit more?
Yeah, sure. So with the R&D tax credit, just you have a 20-year carry forward, meaning I generated tax credit in 2019 of $100,000. I have that on my books or available for use until 2039. And what that means is that you can either use it to offset tax liability as you go on. Maybe 1 year you just have a boomer year, and all of a sudden you owe taxes. Well, then you have that in your back pocket to slap down on the table and say, hey, I have this on my books. I don't need to pay you because I've had this credit. But to the idea of an acquisition situation, merger acquisition, one of the things to remember is you carry that as an asset, right? For valuation purposes and so on and so forth. But I will say that if you are acquired, and when I say acquired, I mean you're purchased and your resources, your personnel are subsumed into the new company. Your FEIN, your federal employer identification number, is going to go away, and along with that, so will credit. So the question then becomes, well, how do I carry that asset into the next round? Well, the answer then would be to be acquired as a complete company, to where you're still operating sort of as a parent-child relationship to the acquiring company, and what you can do is if you're in a part of a merger, and you have this asset on your books, well, then maybe it makes more sense for the other company to be subsumed to you, and for your FEIN to stay intact because of that value. It's important to have it on the books. Important to have it in your back pocket as leverage or credit defray of tax liability or so on and so forth.
I think there's time for one more question. And here it is. Who prepares the information to substantiate my claim? Is this included in Leyton services?
Yeah, I mean, that's basically what Leyton does. That's the kind of the reason for us to have jobs and be here and service folks like yourselves.
Thank you again. And you'll be getting a follow-up email with both the slides and the recording. And please do watch our website for upcoming webinars. We want to teach you as much as we can. So thank you again, and enjoy the rest of your day.
Yeah, thank you, Joan. Thank you, everyone.
Thanks, everyone. Have a great day.